I'm seeing a common sentiment echoing amongst crypto market participants. A lot of people are saying, well, I think Bitcoin and Ethereum are now the only safe holds in crypto, with a lot of altcoins now looking shaky following FTX's collapse. So in today's show, what I'm going to do is look through the historical data of last cycles and look at whether these new altcoins that rose in 2021 will actually survive and perform well in next cycle. I'm talking about your AVAXs, Solanas, etc., or if Ethereum and Bitcoin are really the only safe holds in this market following the FTX saga. It's going to be a massive show. Let's get straight into it. So the question that I want to answer in today's video is, are Bitcoin and Ethereum the only safe holds in crypto? And I think in order to verify this question, we do have to look at the historical performance of altcoins. Now, if we look at the 2017 historical market cap from December 17th, which was the all-time high of Bitcoin at the time, we can see that out of the top 10 altcoins, 4 currently today remain in the top 10. These 4 are Bitcoin, Ethereum, XRP, and Cardano. We saw a lot of the other altcoins that were in the top 10 at the time, NEM, Monero, Dash, IOTA, etc., actually drop off. Bitcoin Cash coming in at number 3 at a $31 billion market cap. Now you can barely find it in the top 20. It's now number 27 with a market cap of 1.9 billion. So this just goes to show that not every single project actually survives cycle to cycle. If we look at the top 10, obviously Bitcoin and Ethereum stayed. However, if we go further down the list, as you go further and further down, many of these altcoins are really not here to be seen anymore. Hypercash, Bitcoin, NXT, Monocoin, etc. So many of the projects did exit the top 20 from 2017, and I think that only alludes to the conclusion that many of the top projects from 2021 will actually fall off as new narratives gain traction. And it's our job as investors to identify these new narratives for next cycle, because we want to be investing in the next hot thing and not yesterday's hot thing. And I think FTX made this very prevalent, as a lot of the artificial propping up of some of these altcoins is now being stripped away, and we are really going to see which projects are building in the bear market and which are succeeding at that mission. Sectio Divina did a very interesting thread saying this can't 100x, bro. It's already a $100 million market cap. And he analyzed the CMC historical data from 2015 to have a clear idea of market cap historical evolutions. Because when we're investing in crypto, we want to verify from cycle to cycle what kind of multiples we can get in different categories. Because to answer this ultimate question of, are Bitcoin and Ethereum the only safe holds, we also have to look at risk reward. And one way to do that is to measure cycle performance from cycle to cycle in terms of multiples. And there are some very interesting statistics here. So in the 2015 bear market and then to the 2018 bear market, we saw the number 10 on coin market cap was worth 7.5 million. The next bear market a few years later, so next cycle, we saw a 172x of the number 10 slot. The number 20 slot went from 1.4 million to 298 million, which was a 214x. And then we saw number 50 actually rise 260x against its position in 2015. So what this suggests is, as you go further and further and further down the list, the smaller the caps that you invest in, the more multiples these projects tend to do versus their top 10 counterparts. And we can also verify that from cycle to cycle, we have seen an increase amongst all market sectors from the top 10, 20, 50, and 100. And the way we do this is by looking at 2018 against 2022. Now we see the law of diminishing returns start to kick in at this point, when the 2018 bear valuations went from 1.3 billion in terms of the number 10 market cap to 8.3 billion, which was only a 6x, so a big increase on 2018, but nothing compared to the 172x we saw the cycle before. Then we see number 20 rising at 12x versus the number 20 in the last cycle rising at 214x, so diminishing returns here. Now we can see that over time, the returns tend to diminish, and he also plotted out the peak bull versus the peak bull valuations in the next cycle, and we see similar returns from cycle to cycle here. So what we can really conclude about this is we have to identify projects that are fitting that next narrative. And yes, you will get that in the small caps. So I guess that kind of goes against the question of, are Bitcoin and Ethereum the only safe holds? Because, well, no, that's not necessarily the answer in my opinion. However, we do have to be careful here, because when we are picking small caps, it does come with a significant amount of risk. So I actually prefer to reframe this question as, are Bitcoin and Ethereum the optimal holds, or what percentage in which do Bitcoin and Ethereum become the optimal holds. And that is what I want to discuss right now with the changing landscape of crypto. So, okay, if we look from cycle to cycle, you can verify that many projects dipped off. And if we take that logic, we can only assume that many other projects will continue to fall off heading into next cycle. If we look at Bitcoin and Ethereum, they did stick around, however. But I do believe that there is one big change that has happened, one big shift that has happened in crypto since 2017. And this is the changing of the landscapes. And this is one of the reasons why I believe the next cycle will be very different from what the last cycle was. And it's one of the reasons why I believe that there are still many valid altcoin investments. And this is the fact that we are now starting to see genuine network effect kicking in. If we look at the Metcalfe's law, we can confirm that the value of a network increases to the square number of the users in the network. AKA, the more users a network gains, the more value that network will tend to attain. And if we look at Ethereum's overall user data on the Ethereum unique address chart, we can see that the Ethereum unique addresses has been steadily increasing over time. And even amidst all this FTX drama, we have still seen a daily increase over the last few days of over 100,000 users. Now, if we look at Polygon, because Ethereum is what I would consider to be a pretty safe asset. If we go down the list a little bit and look at an L1 that I like in Polygon, we can see the exact same trend. Polygon is actually gaining users. And what does this mean? Well, the more users that a network gains, the more different points are now connecting to each other, and the more users are interacting with each other and talking with each other. Think about it as the growth of the phone network. When Metcalfe's law kicks in, this is how a network actually attains value. And this is why I do think the 2022 cycle and the next cycle are very, very different from the last cycles, because we didn't really have utility there. There wasn't a reason for many users to onboard into crypto, and they didn't have real applications in 2017 like we have today. I mean, now you have money markets, you have games, you have staking, you have storage and privacy protocols, you have so many things to do with your crypto these days. So this only alludes to the point that projects with real utility will prevail. And it's our job as investors to find those projects with real utility. But obviously after the FTX saga, this does become a little difficult. Alex Kruger said, if looking into anything other than Bitcoin and Ethereum, a good idea, in his opinion, is to focus on DeFi assets tied to useful decentralized trading solutions. This is obviously a narrative that has come to fruition in recent times, especially as many users are now offboarding from centralized exchanges to decentralized exchanges. And I'll show you the stats on this in a minute, because it's mind-blowing, the seismic shift we are now seeing from CeFi to DeFi. And Alex said, my framework now is in December 2018 to March 2019. So that's where he thinks we are in the current cycle, relevant to the last bear market. Wide range, still significant upside within it, hard to trade, pain. Think macro correlations will creep back up within a few weeks and could easily change that. And I do think, considering the volatility of the market right now, implementing a DCA approach, at least for me, given my mental temperament, is the best approach for me to take. And that's why I've been building portfolios that can survive not only the bear market, but also can look to capture upside in the next bull market. And I'll be sharing these picks with you guys on the shows over the next few weeks. But at the end of this video, I do have a portfolio that I made on Nested that I want to share with you guys that you can actually copy and DCA into yourself with your own weighting. So the question now becomes, how do we find the next narrative post FTX? Because I do think the FTX collapse highlighted one thing, and that is the fundamental need for DeFi in cryptocurrency. What happened is there is now a distinct lack of trust amongst centralized entities. Many exchanges, users won't feel that comfortable holding their funds on these exchanges anymore. A lot of users now don't feel comfortable trading on these exchanges anymore. And I do think we will see an acceleration of certain aspects of DeFi, especially some of the exchanges that capture upside to this, like the perpetual DEXs, etc., which we've been talking about on the show for a while, because that is where many of the users that are detracted from CeFi will actually flow into. Unfortunately, I do think this whole FTX saga did highlight one thing, and it's that humans are greedy and flawed. And I think every major collapse this year can be attributed to this notion. And decentralization, if you look at the essence of why it was created, it's to avoid human emotion. And I do think it's a real shame that this industry keeps experiencing headwinds due to human nature, when the technology itself, it was invented to be perpetual. It was invented to operate in a decentralized manner that doesn't involve any centralized entity. And we've seen with Do Kwon, with SBF in recent times that centralized entities have been responsible for many of the flaws in crypto. So I do think we need to work towards a future where the tech is used as it's intended and isn't exploited by bad actors. And one of the ways you can do this is DeFi. Now, I'm not going to sit here and lie to you. I certainly do think DeFi might take a hit in terms of its overall regulatory headwinds as regulators do look to regulate crypto now. This means that DeFi may take an unwarranted hit. Even though it solves some of the problems that CeFi and SBF have created, it will come under the jurisdiction of any regulatory implementations that do come out over the next few weeks or months or years as the regulators start to scrutinize crypto. So that is a genuine headwind for DeFi. But I do think the obvious shift in crypto is now going to start occurring. And Jordi Alexander did liken this to being like the COVID accelerant moment. So remember during COVID, when a lot of people used to work from the office, and then all of a sudden, a few months later, everyone worked from home. I mean, look at me right now. I'm working from a hotel in London, and you have many people now working at their jobs from home. My parents work from home. I have many friends that work from home. That shift happened in a few months, but it was always happening. And that was always going to be the future of the working environment. It was always going to pivot towards the flexibility of working from home. That exact same thing, in my opinion, is now happening with DeFi. I think there is going to be a migration towards DeFi exchanges because although this FTX collapse has triggered it, it was already happening for a while. We already saw DeFi volume increasing significantly, DeFi trading volume increasing significantly. I think this has just really accelerated it. Jordi does go into some of the caveats, however, in terms of capturing upside, and I highly recommend checking out his thread because he does have his doubts about some of the protocols that rely on oracles with decentralized exchanges. Very valid points in my opinion, but I do think his original point stands, which is this is the COVID accelerant moment. Now, Patrick came out and said that there's lots of strength in on-chain perp dexes and wallet tokens right now, as we have seen a lot of people pivoting from CeFi to DeFi. And I just want to run through a few of the data points here so we can kind of verify our thesis on this potentially being one of the next narratives. So look at the user change in the decentralized finance applications. We saw many of the major applications, Compound, Curve, Aave, Synthetics, DYDX, increase almost doubling in the past week in terms of decentralized finance growth versus centralized finance. This is very interesting to see the amount of users actually growing in DeFi despite the market having headwinds. And this is an interesting statistic because in theory, we'd kind of expect a lot of participants to be leaving the market now. People are scared, people are worried, people are leaving crypto, and people are losing interest. It's clear that the social sentiment has taken a huge hit. However, it is interesting to see at the same time, in parallel to sentiment taking a huge hit, that users are actually increasing across DeFi protocols. And DEX trades, the USDC in particular, reached an all-time high yesterday on Uniswap, which is quite a staggering data point here, that 300,000 weekly trades were executed on Uniswap. Now, it's not just Uniswap that is capturing some of these users. We're also seeing perpetual dexes like GMX and GNS starting to capture some of these users. We can see GNX has now hit its all-time high in revenue, generating $1 million in revenue per day. We can also see that it is gaining new users following the fallout of FTX. So to verify a thesis, we have to look at hard data. And the hard data is only telling us one thing right now, and that is that people are shifting. We're not speculating anymore. We're not saying it could be a COVID accelerant moment. The data really speaks for itself right now because we have seen a massive influx in not only trading volume, but fees and new users to some of these perpetual protocols. So GMX has also shown extreme price strength despite a lot of the market taking a hit due to a lack of sell-side liquidity. And we had that crazy 200K market buy yesterday, which created a 20% wick. So people are buying and actively spotting this trend. Now, GNS, Gains Network, which in my opinion is my preferred out of the two to use. Actually, no, not to use because it's on Polygon. I don't like Polygon. It's the preferred interface in my opinion because they are launching on Arbitrum, and then I think it will be the better exchange to use. But we now see daily users are over 630 per day. That is the highest amount of active daily users we've seen in recent times. Actually, no, ever. And we've seen the cumulative users also hit their all-time high. And GNS is also exhibiting strength in terms of trading volume. Uniswap, very similar thing, has more volume on ETH than any of the centralized exchanges in the last 24 hours. I mean, isn't that just crazy? Uniswap has more volume on ETH than any of the other centralized exchanges. Like, that's nuts. People are actively trading on DEXs now more so than ever relative to centralized finance. Wu Blockchain says, due to the loss of trust in centralized exchanges, the trading volume has increased. V3 and V2 has burnt more than 2,300 ETH in 7 days, which has caused ETH to fall into deflation. That is actually a very interesting point. It's one of the minor reasons why I'm bullish on ETH post the merge. I do think the impact of the staking side demand for the token and also the decreased supply issuance in Ethereum is one of the reasons I'm most bullish on Ethereum as an asset hold long term. However, this is another point that I think a lot of people are missing, and they're remiss of the fact that the more people that trade on DEXs, if it's on the Ethereum network, the more Ethereum is going to be burnt. So if this shift does occur, that doesn't just have inherent benefits from your Uniswaps, from your Aves, from GNS, GMX, it also has inherent benefits for the Ethereum network itself. And I think that's a point that we just can't gloss over because it can have ramifications. And we can see this exhibited by the amount of daily average fees, which are now over $4 million on the weekly for Ethereum. In fact, in the last day, it's done $2.5 million worth of fees. Uniswap coming in at a staggering $1.5 million in fees. Binance Smart Chain has now been overtaken by Uniswap, which is absolutely crazy in my opinion. So it's clear that a shift is occurring. And it's clear that a shift is not only happening from centralized exchanges to DEXs, but also that potentially this could benefit the entire DeFi ecosystem as a whole. And why do I say this? Because when we actually think about what's happening right now, and if we break it down to the bare basics, people are transferring out of centralized exchanges into decentralized exchanges. Okay, what does this mean? Well, this means more users have funds now on their MetaMask. This means more users have funds on DeFi applications. Now, the more funds you have on DeFi applications, the more exposure users now have to the DeFi ecosystem, because there are many retail participants in this market that trade on centralized exchanges that never touch staking in their lives because, I don't know, it's too hard to offboard from CeFi over to DeFi. So they simply just don't want to touch those ecosystems. I think this now creates a very unique on-ramp from CeFi to DeFi because people are now going to be forced to leave. I mean, just look at, I'm pretty sure Trezor and Ledger would be selling a crazy record amount of hardware wallets right now because people want to store their money in places they consider safe. The FTX situation, it has degraded a lot of trust amongst the industry as a whole. And now people have their funds on DeFi. That does expose you to applications like Lido Finance, where maybe people will now want to stake their Ethereum. It may expose people to Aave. Maybe they want to stake their tokens or lend their tokens and borrow money against it using those tokens as collateral. There is now genuine use cases which can prop up out of this. My only caveat to this entire narrative, when we do look at DeFi as a whole, is obviously the regulatory aspect. Now, I did speak about this on my show, I think it was on Friday or Saturday, and I said that there are headwinds for DeFi, and I'm not remiss of that fact, and it's definitely going to be an uphill battle, and I'm very interested to see how the regulators actually decide to step in and regulate this. But I just hope, as a DeFi proponent, as a fan of the ecosystem, that the regulators do clamp down on these centralized exchanges first, and they do clamp down on the human nature aspect that I alluded to before, which has caused so many of the problems in crypto. So I guess if we're answering the question, are Bitcoin and Ethereum the only safe holds? My answer would be no, but we can change this question to Bitcoin and Ethereum being the safer holds. Of course, they're going to be the safer holds. They're around next cycle. They're around the cycle after. They'll be around next cycle. But in terms of upside, obviously, if you are investing in smaller caps, you're going to get bigger upside. That's where you're going to get your 50, your 100x's, your 200 plus x's next cycle. But we do have to keep note of our portfolio weightings. Now, there's a mistake I'm seeing a lot of people make, and I want to address it now before I get into my portfolio. And that mistake is risk off versus risk on. Now, what I'm seeing a lot of people doing at the moment is commenting on my Twitter and my YouTube saying, I don't trust anything in crypto right now. You know, I'm only going to invest in Bitcoin and Ethereum from now on. My trust is broken. And I completely understand that notion because seeing your altcoin positions degrade, it's really hard. And it really, really hurts seeing your portfolio drop. I completely understand that. But the problem with the approach of going risk off during a market that is reaching a generational bottom potentially is you're not really doing what I would consider to be the pragmatic thing. And that's actually going risk on when the market is scared and then risk off when the market is hot. So I personally believe the time to position yourself in stablecoins, Bitcoin, and heavily weight towards those assets is when the market's hot, when the market's bubbly, like we saw last November, when the market's pumping, that's when you want to go risk off. When the market's down and the market's dumping, and we're reaching potentially what Alex Kruger said is the potential March 2019 moment at the moment, then we want to be going more risk on, because that is the time to start to take risk. In my opinion, fortune does favor the brave in crypto, and that's why I am taking a DCA approach. Now I'm going slow, as you saw on the last show. I'm not going too rash with my DCAs. I am prioritizing some assets. Ethereum, maybe counterintuitively to what I just said, is one of those assets because I believe it can still exhibit great returns next cycle. It's possible for Ethereum to 20x in my opinion. So I've started building portfolios. And what I wanted to start doing for you guys was sharing some of these portfolios, sharing some of these altcoins live every day on the show, and helping you guys get a head start in terms of DCAing. So what I did was I created a portfolio on Nested. I went for one of the safer type of portfolios for my first portfolio because I wanted to kind of create something a little bit safer. And then what I'm going to do over time is pivot into other types of portfolios. So I want to eventually create like 5 portfolios, a DeFi portfolio, a small cap portfolio, a large cap portfolio, and really spread it out. But for now, in the meantime, I've created a portfolio that I like in terms of a little portfolio that you can DCA into. Now, I've created my allocations here as 34% Ethereum, 25% Bitcoin, 10% GNS, 10% Link, 10% LDO, and 10% Sol. This isn't my actual portfolio. My actual portfolio is 30 plus projects. This is a portfolio that you could use to DCA into if you didn't know what to buy and you wanted a little bit of exposure. And these are assets I like. Let's just run through them quickly. Ethereum, going to be one of the top assets next cycle. I think the merge had huge positive ramifications for the network. BNB, after the CZ, obviously the news once FTX went down, CZ said he was buying FTX. We did see BNB respond quite positively. It's since come down, but I do think what happens post FTX is that BNB or Binance being the top exchange now, it really doesn't have much competition. And this token will probably accrue value off the back of that. And it is the center linchpin of the Binance ecosystem. So BNB becomes a bet that I like. It doesn't just become a bet that I like now, though. I'm not just saying this in retrospect. I've been talking about this for months. I think almost since the June lows, I've been saying BNB, BNB, BNB. I think the narrative just became a little bit stronger for that. GNS, I mean, we've talked about it all day in terms of the DeFi ramifications. This is one that once it launches on Arbitrum, I believe can significantly increase its users. My only issue with GNS, I guess, is how it's been pumping recently. Of course, the narrative is very strong. Potentially getting into overbought territory. I'd be careful DCAing into this one, but I do think if your time horizon's longer, then it may be okay. Then you've got Chainlink coming in next, major Oracle. They just announced their new staking roadmap. Staking goes live very soon. They announced some very cool partnerships over the last few weeks, real world partnerships. And I mean, if we look at all the carnage that went down with DeFi protocols like the Solend, the Solana, rapid Bitcoin depegging, we saw many DeFi protocols go bust amidst liquidity issues following FTX. Chainlink's Oracle still operated as planned. It's battle tested many, many times now across many market collapses. And that's why I do believe, although you're not going to get your 100x out of Link next cycle, it's worthwhile having in your portfolio. Lido comes in next because it hinges off my Ethereum thesis that as more people enter the DeFi market, as more people use the Ethereum network, they'll need a place to stake that Ethereum. So it just makes sense that Lido's the major beneficiary, considering you don't have to lock up your tokens and it's a liquid staking solution. And then Solana comes in last in a controversial one these days. The only reason I have it in here is because I still believe in terms of L1s, following this FTX situation, that Solana started to present some value. And I do think as we get closer to $10 and probably even sub $10, this will present value because it still does have a pretty strong ecosystem, in my opinion. It still does have a lot of builders and it still does have a pretty tight-knit community. Yes, it's got major flaws. And in tomorrow's show, I'm going to be running through my entire Solana thesis now. But for the sake of this show, I did put it in my mini portfolio here. But I will be sharing more portfolios over the next couple of weeks and also editing this one because I have control over editing the allocations here as my thesis has kind of changed and pivot. But I wanted to create this one to get the ball rolling on Nested. So what you guys can actually do is if you want to DCA into this portfolio, any amount, whether it's $50, $100, $1,000. You can DCA with my allocations that I've pre-specified on the Nested site. There's a link in the description. I think it's the first sponsorship link in the description. All you need to do is click deposit funds here, and you can literally use your debit card, which I think is a very awesome integration from Nested, by the way. Great job to the team there. You can use your debit card, Visa or MasterCard, to DCA into crypto on DeFi. So not only are you avoiding the centralized exchanges like that have come under scrutiny in recent times after FTX, and you're using DeFi, but you also have a very easy on-ramp. Now, you don't just need to use a credit card. You can use coins that you have in your wallet. I did make this on Polygon, so it's EVM. The reason I did it on Polygon is because it has most tokens. So yeah, you'll just need to add Polygon network to your MetaMask, deposit some Polygon into that wallet for gas, of course, or you can just on-ramp straight in from fiat from your card. So that's how you can DCA into this portfolio. I will be updating these over time, but there's a link in the description to that. And what I am going to start doing is gradually creating more portfolios for you guys. So I created what I view as a safer one right now. It's got a mix of Ethereum and BNB, which are allocated over 70%, which are obviously, or 70%, which are the safer tokens in this list. And then you've got some riskier ones down the bottom, but generally a pretty safe one, in my opinion. Of course, this video is not financial advice. That's just my opinion. I might be wrong. You have to do your own research, of course, as you should in crypto, but that's what I'm doing. So I guess to answer the question of today's video, are Bitcoin and Ethereum the only safe holds in crypto? No, there are going to be coins next cycle that have very strong narratives that perform very strongly. But I do think in times like this, we do have to scrutinize our investments a lot more. We have to be a lot more pragmatic with not only how we approach researching, but how we approach getting our entries, how we approach taking profits. And I do believe if you can do that and create a really formulaic and structured strategy, you can come out the other side significantly ahead, because at the end of the day, although this market is scary, it is creating opportunities. And I can't lie to you, it is going to create some of the most generational buying opportunities, even amidst all this panic, even amidst all this FUD. Of course, FTX did genuinely hit the market in many ways. I talked about it in the last show. It does have bad ramifications as well. It has put us back on progress, maybe by 1 or 2 years. But what it does do on the positive side, because I'm an optimist and I think we should always look at the positive side, is it's created a huge opportunity for us to accumulate some of these tokens at bargain basement prices. So that's something that I'm actively doing. And you guys know I did manage to catch some pretty nice bottom wicks on Ethereum and Lido and Dopex, which is an options exchange, last week. So I'm just building out my portfolio. I'm sticking to the process, and I'm going to be here for you guys every single day to help guide you through the market, these crazy times, and look at the upcoming narratives. But I also just want to claim a little bit of clout before I leave. I have been talking about GNS for months. I called it at $1.50. It's now $3.60. We're up over 2x on that trade. GMX, very similar. Didn't make as crazy profits on that because I was mostly allocated towards GNS. And the same can be said for some of these other DeFi protocols. So even post FTX, we're still up on a lot of our recent trades. So I don't know. I guess you can kind of consider that as a win if that's the thesis that you've been following. But yeah, make sure you smash the like button if you enjoyed this video. Hit the subscribe button as well for more future content like this. Remember, if you do want to DCA into that portfolio I showed you, there's a link in the description on Nested Finance. And I'll see you in tomorrow's show, which is very, very interesting. So make sure you click that bell button because it's talking about the future of Solana. And I'm going to give you a comprehensive overview of where I think the Solana ecosystem is going. There is some really surprising data that I want to share with you tomorrow that could potentially make us some profits. So let's just keep your eye out for that one tomorrow. And until then, I will see you in the next one. Peace.